Welcome to the FarrCast. On this week's special episode, Michael Farr brings you his top 10 for 2024. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week for the final week of 2023. When you next hear us here on the FarrCast, it's going to be a whole new year, a whole new look at the world. Not sure why. Doesn't that sound silly? If we just wait a few days, we get to say all those things. New world, new year, new this, new that. 4 or 5 days from now. It is the 28th day of December. And that means that it's time for my top 10 stock list for 2024. 2024. Here we go to the Farr list for 2024. I've done this for 16 years, ladies and gentlemen, 16 years. And this is a list that we cull from different portfolios at Farr, Miller & Washington. I have money invested in all of our strategies, all of our names at Farr, Miller & Washington. And then years ago, I was asked to put together a concentrated list for a state pension fund in Pennsylvania. And they wanted a track record of a concentrated names. This is what they were looking to do. And the state of Pennsylvania never bought this strategy from me. They never hired me. But as I got started with it and I started to build the track record, it kind of turned out to be fun. So these are not recommendations to buy or sell any security. I don't suggest you do anything. I'm just letting you know here what I do, and I'm following a tradition of many years. I'll be on CNBC this afternoon to announce my list for 2024. Lots of viewers follow this every year. Good years and bad years. Some years it does better than the markets, S&P. Some years it doesn't do as well. So any past performance is no indication of what may happen this year or any other year. I have reasons for picking some of these names, and I'll go through them with you. So, and I guess finally, as a housekeeping note, tomorrow on the 29th of December, last trading day, I will sell the names for 2023 and buy the names for 2024. If there are some names that are duplicated, replicated from year to year, where I'm keeping some of last year's names again for 2024, there may not be a transaction in that name. Won't matter. It's just keep a name on the list. I don't need to sell it and then buy it back again. So that's what I'm thinking about this year. This year's list is more defensive than in years past. I do this in an equal dollar weighted amount, but I was pretty cautious at the beginning of 2023. I was pretty wrong to be cautious. Another reason to go ahead and be invested, folks. I bought my list. I was very cautious. And the list, I made money on this list. We had, I don't announce the performance for various compliance reasons. You can check. Last year's list was published on CNBC. It did not do as well as the S&P 500. So I can tell you that. I hope that the list in 2024 does. We shall see. This is defensive. Economic indications are that we are slowing. I have expected a recession. I still think we've got a slowdown coming. This is the recession that's never happened. All right. S&P 500 this year was up 24%, right thereabouts. We'll see where it closes tomorrow at the close, but 24%, that's a hell of a good year. Amazing year, driven largely by 7 stocks. And then the rest of the market, rest of the 493 stocks didn't do quite as well. They were still positive, but didn't do quite as well for the S&P 493. I think that should be the new index, the S&P 493. Doesn't it have a good ring? I like it. Okay, so with all of the disclaimers and qualifiers in place, I want to just give you the overview of my list for 2024. Can't believe I'm saying 2024. You know, I started in this business in 1987, just before the stock market crash on October 19th. What a difference. What a world of difference I've seen over this career. And I've learned a lot from a lot of wise people. I've learned a lot from making a lot of mistakes. And by narrowing down that list of qualifiers that I use to pick stocks, to hold stocks. And yeah, I keep thinking about that one old adage of the very, very wealthy billionaire. When they asked him how he made all his money, he simply quipped, "Well, I never sold anything. I just never sold anything." That might be my best advice, just to never, ever sell anything. Certainly for people investing in the S&P 500, folks, in your 401ks and other things, if you're a long-term investor in equities in the U.S., you have made money. There's no guarantee you will in the future, but that is a pretty good investment theory, philosophy, approach, as far as I'm concerned. My list this year, I'm looking at 2 industrials. I'm looking at 1 financial. I'm looking at 3 healthcare, 1 consumer discretionary, 1 consumer staple, 1 communication service, and 1 tech. How about that? Those, as an industry breakdown, should be pretty defensive. You're not seeing me go for those high flyer stocks, but then again, my name is Farr, and I never go for those high flyer stocks. I'll give you a couple other stats before we start with the individual names. Price to earnings multiple for the S&P 500 estimates for 2024, 19.5 times. For my list of 10, 22.5 times. So Farr's valuation multiple, price to earnings multiple, is higher than the S&P 500 average. That's unique, and I'm about 10% higher, about 10% higher. The average earnings growth rate, long-term, 5-year or so earnings growth rate for the S&P 500 right now, longer term, is about 5 or 6%. 5 or 6% longer term from these levels. For the companies I have selected, my average is 12%. Now, if you know the rule of 72, you'll know that that money should double in about 6 years. 6 years for money to double, compounded at 12%. So earnings, those earnings should double if they can keep up that rate, and if that average rate is right, at 12% earnings growth. So if I'm paying 10% more for my list than the market average, and if the earnings are substantially, if not almost twice the S&P 500 average, and I hold these names, that should drive out performance. Earnings growth, the most significant indicator of stock price performance over time, says Peter Lynch of Fidelity Magellan. Earnings growth is the most significant indicator of stock price performance over time. I always like that. By the way, the average dividend on the S&P 500, 1.5%. Average dividend for my selection this year, 1.5%. Boy, a couple of years ago, that would have been just fabulous, wouldn't it? And now we've got T-bills over 5%, 6-month bills. It doesn't look as good. Let's start with one of my industrial names. Let's do 2 of my industrial names to start with. Let's go with Donaldson Companies. I've owned Donaldson a long time, global manufacturer of filtration systems and replacement parts for engine, for on and off-road trucks and machinery, transportation, construction, agriculture. Okay, this is a real smokestack, not to offend environmentalists, but I mean, this is a nuts and bolts old industrial kind of a company. Management runs this business for the long term. I like that. So it's continued and will continue to invest in R&D, bolt-on acquisitions. Company's balance sheet is very strong. Free cash flow is pretty much up to net income on an annual basis. They've increased its dividend every year for the past 25 years and has increased at 13% since 2000. So this stock trades more in a line of a multiple with the S&P 500. But we're at 19.6 times earnings for my estimates for 2024. I think the earnings are going to grow at 10%, and I'm going to buy it. I recognize, folks, that with the markets nearing all-time highs, I'm not buying low in general. I'm not buying low. This is hard for me to do, to buy stocks right now when the market's nearing all-time highs. I'm a very disciplined investor, but this particular strategy says I have to buy tomorrow. So if I have to buy tomorrow, what am I going to buy tomorrow? It's a more defensive looking list, right? With the market trading near all-time highs. Valmont Industries, number 2 on my list for this year. Relatively small company. I've owned it for a number of years. Fabulous company. They manufacture engineered poles and towers, so utility poles, that sort of thing. And they benefit from infrastructure spending, utilities, telecommunications, access system for construction sites. They do metal coatings and irrigation systems. And so it's, again, a nuts and bolts system. They're going to benefit from more infrastructure spending and for a 5G telecom rollout as they have to establish more of these towers and poles and other things that they use. 15 times forward earnings, 15 times earnings. So a pretty good discount. Now, industrials like this are going to trade probably at a lower multiple by and large. Donaldson doesn't. It's pretty much equal. But this one, smaller company, 15 times earnings. Growing earnings at 9%, I still believe superior to the S&P 500 at a discount PE to the S&P 500. So Valmont Industries is on my list. I like that, and I like to hold stocks for 5 years. Very difficult for me to sell a stock after a year. Just doesn't make any sense. Let's go to the financial name on my list, Goldman Sachs. You never bet against Goldman Sachs, folks. Just been one of my rules for 30 years of investing. You never bet against Goldman Sachs. They might, flag 1 year, 2 years here and there. Overall, as I've said, and I joke for years, though I'm only half joking, sometimes the customers at Goldman Sachs, investment banking or investing customers, lose money, make money, but Goldman Sachs always makes money. Goldman Sachs, they've got that figured out. I'm being somewhat silly when I say that Goldman Sachs always makes money. Sooner or later, they make a buck. It's never paid for me to bet against Goldman Sachs, certainly not following the great financial crisis. This company is very well capitalized, pays a dividend at 2.9%, trading at 1.2 times book value. I like Goldman Sachs. Next, Danaher. Danaher is, again, a name I've owned for years. They separated their environmental and applied solutions business in September. They become a pure play biotechnology, life sciences, and diagnostics company. How about that? Danaher, now biotech, life sciences, and diagnostics. Their evolution to this current state occurred through a long series of acquisitions and divestitures designed to generate shareholder value through the application of the company's proprietary set of operating processes and tools that it refers to as Danaher Business Systems. So it reflects a commitment to use their process to continuously improve every aspect of our business. I have found this one of the best managed companies anywhere over a lot of years. So they sell into high-end growth markets. They have recurring revenue, strong free cash flow generation. You're hearing Farr's themes here, aren't you? Recurring revenue, strong free cash flow, excellent track record, and the stock is rarely cheap. So this is one of the more expensive names on my list. 29 and a half times next year's earnings for Danaher. I'm now listing it in the healthcare space. I believe those earnings will continue to grow at 12%. So an expensive name, solid balance sheet, solid operator. Let's go to another expensive stock. Let's go to another expensive stock and the most expensive stock on my list. And this is a company where the founder and owner began his career as a public company by telling Wall Street that earnings don't matter. I couldn't believe it for years and years and years. And to the man's credit, they have not mattered for this company yet. The company, as you might have guessed, is Amazon. I like the AWS, the cloud web services. They are the market leader in cloud infrastructure. They have a huge presence in AI. They have cash flow, tons of free cash flow at Amazon, $40 billion of free cash flow in 2023. How about that? That's up from a negative $11 billion in 2022. So Amazon was among the top performing stocks in 2023. I'm going to continue to ride Amazon. and I think they will continue to grow. AA rated by S&P 500, and I think they're going to continue to grow this company probably close to 30%. 30%. So why will Farr pay 40 times? Think about my ratios of these other companies, what I'm willing to pay. And 30% earnings growth is where I think Amazon can continue as they expand their business model and floor plan. Consumer staples next. Old tried and true of mine. Remember, I'm being a bit defensive. Pepsi-Cola is one of my favorites. Pepsi-Cola has had a really good past few years. They are trying to transform Pepsi into a faster, stronger, better company through a couple of strategic initiatives. One, they're reinvesting into the company's brands with innovation and marketing. They're addressing their portfolio gaps in some of the more fast-growing categories where the company had been underpenetrated. And three, they're enhancing the supply chain by increasing manufacturing capacity and introducing efficiencies with a lot of investments through technology. So their past reinvestments have really raised the bar on execution and distribution. Pepsi's been executing really, really well. And I think they've demonstrated, a little bit to my surprise, really exceptional pricing power. I'm a little concerned about these GLP-1 drugs. I'm watching that with Pepsi, but I'm very comfortable with Pepsi over the next year anyway. I think it's going to continue to be a long-term hold for me. A+ rating for S&P 500, has a 3% dividend. They have increased the dividend for the past 50 years. It's 20 times next year's 20 times next year's earnings. And Pepsi going to be one of my slower growth companies out there at 8%, but I think they might still have some leverage and surprises in front of us, and as you know, a very solid balance sheet. Here's another one for you. Communication services. Now, think about this. Communication services is the way S&P has this next company categorized. Would you say that Walt Disney was a communications services company? When you think about all of their media, when you think about all of their streaming, all of their movies, all of their everything, theme parks don't really fit into a communication services, but that's the category. So Walt Disney's had a very difficult time in recent years, both in management and stock price performance. I think I've liked this company for a long, long time, as many of you know. 19.8 times earnings, so right on the multiple. 15% grower. 15% grower. I think that the Disney Plus still has a whole lot of leverage. That's their online streaming service. They're picking up millions of subscribers. Yes, they compete with Netflix and some of these others. They have content. Disney has content, and Disney has servers. And when you get all of these subscribers on, you can start to increase the price for those subscribers. A lot of control with Disney. What do we do in a post-Iger world? That remains to be seen. But earnings growth, 15%, and paying a market multiple with a good balance sheet like Disney's. I'll do that a long time. Let's go to healthcare. I've got two names for you. One, Abbott Labs. Let's go with Abbott. This is the best-in-class medical device company, okay? Medical device. It's diversified across 4 different segments: medical devices, diagnostics, nutrition, and then established pharmaceuticals. I like the mix. I think it's compelling, and I think it's going to generate durable growth, and I think it's going to have new and upcoming product launches that's going to support future growth. They have had great success with this Freestyle Libre, which is the monitor for diabetes around the world, constant monitoring for type 1 diabetics. And that Libre is one of Abbott's largest products today. Its potential for growth, I think, is significant as they go forward. So this price earnings multiple, not necessarily cheap either, 23.6 times. Its medtech peers are a little more expensive, closer to 25 times. But I think we have double-digit earnings growth here, double-digit earnings growth. Remember, I've got an S&P 5-6%. That number's lower. And a 2% dividend. So I like that. Let me go to one of my favorite names forever. Just a core anchor in my portfolio. If this is the best performing name that I have on my list in 2024, this next name I'm going to tell you, I'll eat my hat. I don't expect this to be the best performing name. And that probably doesn't matter, ladies and gentlemen, what I expect or don't expect. But Johnson & Johnson is a company, I probably have owned it for 30 years. On and off. I don't know that I've ever been out of Johnson & Johnson, but it wasn't for very long if I was. Johnson & Johnson is one of the world's largest, most diversified healthcare companies. And after they spun off, they had a spin-off of this consumer health business called Kenvue. And then their revenue base now consists 65% from pharmaceuticals and 35% from med tech. They're expected to continue benefiting from the aging global population. And despite the upcoming patent expiration for their biggest drug, I think they've got a very promising pipeline. AAA balance sheet. The stock trades at 14.5 times next year's earnings. That's a 25% discount to the S&P 500. It's an attractive multiple. It's got a 3.1% dividend. I think that it will grow faster and in a more stable fashion than the overall market over the next 5 years. But I don't think it's one of my least exciting names. And I love boring. Get rich slowly. It makes a lot of sense to me. Get rich slowly. Anything that goes up really fast can go down really fast. Give me a good, steady climber. I hope that Johnson & Johnson will continue that path. If not, it doesn't. And the world's different, which is why we always say past performance is no indication of future results. Finally, here we go. The last name. Last but not least. Last on your program, but could be number one in your heart. Microsoft. Oh, come on, Farr, you're buying Microsoft at this price after the year they just had? Yes, I am. And I hope I never sell Microsoft. Talk about wanting to own something forever. One of the largest tech companies in the world. They've pivoted. Think about what they've done from a Windows PC world to the cloud. They're leading the way in generative artificial intelligence. The company is strategic partner in enterprise digital transformations with the cloud and their apps and infrastructure, artificial intelligence. There's a long runway remaining for the cloud as a company deals with legacy investments that they're still getting rid of, but they're uniquely positioned to grow its share of wallet and corporate IT budgets. It's got new opportunities in security and compliance and workflow and open AI. So not cheap at 31 times forward earnings on an EPS basis, on an earnings per share basis. Microsoft, I've got continuing to grow at 15% a year on those earnings, 15% a year on those earnings. So with Disney and Amazon, those are my top earnings growers. So I think a top earnings grower, a AAA balance sheet. You're hearing themes, aren't you? These are really, in terms of their balance sheets, some of the most solid balance sheets that I'm finding out there among some of my names. And earnings growth and cash flow and things that give good management teams lots of flexibility. Let's just contrast that for 1 second to think about companies that have a lot of debt, that are trying to gain market share, that are trying to find a footprint, that are trying to do so many things. And if they stumble, or if they have to refinance a big portion of debt at higher interest rates than they've seen in several years, do you see the challenges? Rising employee costs, everything. If you've got cash flow, folks, you can do a lot of things. Do you remember a company? Many of you will not. A company called Corning Glassworks. Corning Glassworks used to make bakeware, but they had a good balance sheet, and nobody wanted to own them because they were so damn boring. Boring! Oh my God, boring. But right in the late 90s and beginning of the 2000s, they figured out that this Corning Glassworks could also be quickly retooled for not too much cost to make fiber optic cable. And they went through the roof. I've always been advised by actually John Washington, my partner, and some other very old, experienced investors, that if you find a good company with strong management, even if they're out of step with their current offerings, take a look at the balance sheet. Take a look at management's history. They have the ability to find another course, to chart a new path, towards success. Companies that are strapped, companies that have debt, companies that don't have cash flow, don't have resources, and they don't have flexibility. So I like these companies with big flexibility, lots of cash and good cash flow. It's a theme every year with me. Think about your own household. So many households in this country can't figure out what to do if they have a $400 emergency expense. Can you imagine how you'd feel if you went to bed at night and didn't have $10,000 in cash and savings somewhere? Well, there might be some of those folks listening, but I doubt it. If you're listening to the FarrCast, you probably do have those sorts of savings. But the more savings you have, as you know, you feel a little bit better, don't you? You feel a little more bulletproof. That's what I like with the companies I own. I want them to feel bulletproof. If they feel bulletproof, then I feel more bulletproof with my investments. And I know that there's risk out there. I know that I could lose every penny I invest in this portfolio. I know that I could lose every penny I have invested in the stock markets. And I mean that. I know that I could. I don't believe that I will, or I wouldn't be there. But I know that I can. So there's a risk of loss with any investment, other than the presumption that if you own U.S. Treasuries, there's no risk of loss because there's no risk of losing the United States of America. I suppose there's even a risk for that on some level. But here's my list. I'm investing in it as of tomorrow afternoon. I'll own all of these names, and I will sit on my hands for the next year. My partner, John Washington, had one other line that I loved. Essential to successful investing are two things: masterful inactivity and benign neglect. I promise both of those are true: masterful inactivity and benign neglect. He was tongue-in-cheek, of course, but don't fool with your portfolio. If you're investing for the long term, don't sit there and make these short-term decisions, and don't have the short-term frets. Do lots of analysis and make your decisions for the long term with your financial professional. Talk to your advisor at Hightower Advisors. We've got a wonderful group of professionals, thousands of us actually, at Hightower Advisors across the country, there to help. And we know the world is not one size fits all. So if what I do and my conservative approach doesn't appeal to you, there's a Hightower Advisor for you out there too. More aggressive, more conservative, all over the board. I'm so grateful to all of them and all of my colleagues at Hightower Advisors. I'm so grateful to all of you listeners for the past year. We've added thousands of listeners this year on the FarrCast. We thank you very much for that. Grateful to the CEO, Bob Oros, in Chicago, a wonderful friend for many years, and his leadership of Hightower, to my great friend Stephanie Ling, on TV as our great representative, as our chief investment strategist, my counterpart as chief market strategist for Hightower, trying to just give investors the tools to make the right decisions, the best decisions for them. The best investment decision you can make, folks, is the best one for you. I hope that 2024 is filled with all good things, much health, much happiness, and prosperity for you and your families. For Harry Jennings, our producer, all of our wonderful regular guests at the FarrCast, everybody at Farr, Miller in Washington, Happy New Year. Thank you. And we'll be back next week and again next year as we cover Wall Street, Washington, and the world, providing you with the best insiders, information we can to help you sort through the complexities of the day, the world, and the investment landscape. Thank you so much, everybody. Happy New Year.
Thanks for joining us on the special Top 10 for 2024 episode of the FarrCast. Please share with friends and colleagues. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Google, Spotify, TuneIn, and Apple Podcasts. You can stream past episodes as well as subscribe so you never miss a new show. In each of the past 16 Decembers, Michael Farr has selected and invested personally in 10 of the stocks we follow with the intention of holding for just 1 year. These companies in the top 10 we find especially attractive in the light of their valuations or potential to benefit from economic developments. Michael holds an equal dollar amount in each of the positions for the following year, then reinvests in the new list. Top 10 for 2024, as presented in this podcast, is listed in random order. The top 10 list is a thought experiment, actively testing which stocks within our discipline will perform the best over the course of the next 12 months. It does not represent a complete portfolio, but a sample of what we are invested across the breadth of our firm's holdings and strategies. Results for the top 10 have been good in some years and not as good in others. The listener should not assume that an investment in the securities identified was or will be profitable. These are not recommendations to buy or sell securities. There is a risk of losing principal. Past performance is no indication of future results. But if you are interested in any of these names, please call your financial advisor to discuss. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. As always, we can be of assistance at Farr, Miller & Washington. Please reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. Take care, stay safe, and stay healthy. Have a great holiday season and a happy and prosperous 2024. Thanks for listening to the FarrCast, Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and/or legal advisors for related questions.